Bienvenidos a esta nueva edición de Trading, Risk and Beyond. En esta ocasión contamos con la visita del profesor Rohan Rao de Georgia Tech University. El profesor Rao, quien ha estado desarrollando modelos para los mercados financieros en los últimos años, conversará con nosotros sobre la creciente crisis de confianza en los modelos, sobre el equilibrio entre estrategia e intuición, sobre la fijación de precios, a quién corresponde, a los traders o al algorithmic trading. Acompáñenme para discutir estos interesantes temas con un profesor a la vanguardia del desarrollo de las soluciones financieras del presente. Bienvenidos a esta nueva edición de Trading, Risk and Beyond. En esta ocasión, con nosotros se encuentra Rohan Rao de Georgia Tech. Discutiremos la validez de los modelos, el futuro de los modelos y uno de los temas más actuales, el de Model Risk. Mr. Rao, thank you very much for being here with us. Well, first of all, I would like to ask you, quants. After the 2008 crisis, especially after the 2008 crisis, quants kind of had a boom, you know. Everybody wanted quants because it was sexy, it was good for marketing, etc. What is really a quant? Since a lot of our audience are just common people, it would be good to pin down the concept. What is really a quant? First, and second, do they still reign in the markets, or are we approaching the end of the era of the quant?
Okay, yeah, they're really great questions. Firstly, I just want to thank RiskMathics and you all for an opportunity like this. It's always a pleasure coming down here and doing these courses. Get to meet really great people, you know, and share a lot of ideas with them. So it's a great opportunity to come by. And to come back to your questions, I think it's to define a quant, right, which was your first question. So you can see the quant roles have increased exponentially over this time, right? There was a certain time when that was not a discipline by itself. But now you can see that every major institution, every major college actually has a quant finance program. So definitely, you know, there is a lot of demand for quant finance. And the way I see quants is anyone who has the domain knowledge of finance, who understands finance, and also has the technical knowledge to implement the new models and the basic models in finance. So this is how I would look at what a quant is. And there are very few people, I would say, who are at this intersection. There used to be very few people who really understood the technical aspects of programming and coding, and who also understood enough economics and finance to implement these models you know, satisfactorily and successfully. So that is why I think quant people were in a lot of demand, and that is why you had these programs that started, and you had so many people getting hired in some of these investment banks.
Let's talk now about some of the trends. High frequency trading, algorithmic trading, they have been around for a little bit more than 10 years. Mm-hmm. Where are we standing now? What is the state of affairs? Are they growing? Are they mature? Are we going to expect more innovation in the future? What is your take, your view on this?
Yeah, I think my take on this is mixed. One reason being that you've got regulation that is playing a huge part in these high-frequency trading. You know, so they're regulating these high-frequency trades because there isn't enough work in academia to show whether these algorithmic tradings or high-frequency trading is actually a welfare-enhancing or a welfare-reducing. So you do not really know whether they are helpful for the market or not. So in one case, people might say that you know, you have more number of trades that increases the liquidity in the market, makes the price more informative, and makes the prices more efficient. This is what everyone wants. On the other hand, they say that you have high-frequency traders, algorithmic traders that you know, spike up the volatility unnecessarily, right? And they may not really trade on fundamentals, which is what the basic finance has always been on, trading on fundamentals. That is what Warren Buffett always used to, you know, espouse. And on top of that, you also have a lot of technological risk, operational risk associated with it. We all know about the flash crashes that took place, right? So these are some of the things, for me, I think that's why I have a mixed feeling when you have regulation tapping on these algorithmic and high frequency traders, putting more and more rules that they have to abide by, and it is, I think, making it difficult for these people to innovate and carry on the way that they used to. So, I mean, for example, I think this is something that I know for a fact. Some of my friends who used to work in this area, and they were telling me that there is also latency time between when you have a computer that is far away, and there's latency time between the time it takes for information to travel from one computer to another computer. And that is why the real estate in the trading floors had become ridiculously expensive. There were people who, in firms, so firms are willing to invest in the real estate around on the trading floor, putting, having computers placed physically close to these to even stop that small latency time that it takes for information to travel between two computers. So that is the extent to which high frequency trading had actually reached. So physical proximity of systems had become a priority at that point of time. And that's when you had regulation cracking down on some of these things and making it difficult.
Actually, that was one of my next questions. Regulation, that you already touched upon that issue, that regulation is changing the rules. Right. Could we say that part of the fun has gone away, that the markets are not as thrilling as they used to be?
Well, I think there are two sides of the coin, right? You can look at it in many ways. People always talk of quant modeling and modeling, right? What are these models? Now people say, oh, some of the models are wrong, some of the models are right. How do we know? The problem, I don't think, is with the modeling aspect or the quant aspect of things. You can write various models, you can write complex models, you can write simple models, and you can come up with prices. The point, I think, here is how well the market responds to some of these things. So there is a notion which says that there are people who might use wrong models, but if they come up with the wrong prices, market is always self-correcting, and then it can take away the prices. Even if the prices move away from the fundamentals, they can always come back. But then you have these other traders who might want to use some of these models, and also maybe they're not true to these models. They might fix these models, and they might tamper with these models and come up with prices. The problem with big banks doing this is that there are all these moral hazards that come into these big banks. So these big banks are so too big to fail that the government really does not allow them to fail, and they can bail them out, right? So these big banks have an incentive now to take on more risk, okay? If they get more profits out of it, they keep all the profits in their own pockets, and if they fail, then the government comes and bails them out using taxpayers' money. So essentially the idea is privatize profits and then socialize losses. So if the market really prices these models correctly, if the market really assesses these models correctly, then there is really no need to have, you will not have a problem if you have a rogue trader, or if you have certain departments that are fixing these models, or tampering with these models and moving prices away. But that does not happen only because you have certain, these kind of issues. So I never thought that modeling and quant modeling has ever been an issue. If the market really prices everything correctly, and if it has an incentive to price these risks correctly, then quant modeling or complex models or simple models should never be an issue. So the fun will always remain. And I think it's not, maybe to some extent the regulators have these things in place only because it is so hard to regulate these big banks that they have to put these hard rules, sort of, for example, the vocal rule is very harsh because it also it also limits a bank trading with another counterparty. For example, Bank of America can trade only to a certain extent with JP Morgan and not more than that, because they don't want to increase the exposure of these two very systemically important banks with each other, because if one of them fails, then the other would fail. So, and that is the reason you have these sort of regulations, because the market has actually stopped pricing some of these risks appropriately because of all these inherent moral hazard issues. And I think that is where the problem comes. It's not with the quant modeling or any of the other side.
Okay,
I would defend quant models. I mean, although you can always argue that I've been there in this profession, and that's why I would do it. But I think this is my take on it, even being that.
Okay, let's talk a little bit about the algorithms in use in some of the business lines. For example, algorithms used in equity, in fixed income, and FX. How are we standing in each one of these? What are the most common algorithms? And specifically in fixed income, there are few participants doing algorithms in this area, is it not?
Yes. In fixed income, I think there are very few of them. There are not too many around. You would see more of them, in equity markets that are there. And another algorithmic trading area that has really picked up are execution traders, actually. Execution traders make a lot of money because it's a challenge now to execute a large volume of trades without moving the market volume curve. And I think I was talking to one of these persons who was working for a hedge fund, and then he had developed this proprietary algorithm, of course, for his firm. And they had made a lot of money. So the idea there was they're using these models. So one is if you have a lot of data, you can always use that data and optimize on the fly, and then execute your trades as efficiently as possible, following the market curve, because you do not want to move away from the market curve. If you do that, then you do not get the price at which you want to execute that trade. So you get lower prices. So you want to follow the market curve and make your trades go unnoticeable, right? And what these guys had done was they used a semi-closed form solution. Closed form solutions for anything are very, very quick to implement and get answers for. And so these guys had developed a novel method of using the data for optimization, and then they had a semi-closed form solution, and there's a trade-off between the cost and the accuracy. And because optimization with a large amount of data is very costly and time-wise and computation-wise, whereas closed form is going to be much quicker. But if things if things are very volatile in the market, then this closed form solution is going to be very inaccurate in terms of giving you the right prices and the right execution strategies. And so they would use a combination of the optimization as well as the semi-closed form solution to come up with great execution strategies and algorithmic trading strategies. And this is something that I think the market is moving into. So making use of these combinations of closed form versus optimizations in it.
Gracias por acompañarnos en el más reciente programa de Trading, Risk and Beyond. Lo esperamos en las siguientes ediciones. Soy Gerardo Herrera, su anfitrión.